Well, the WEX word of the day is visibility, because that's what's getting investors anxious about the next couple of days until we hear from the Fed and CPI. I think investors are anxious and they want visibility.
All right, so looking for some visibility. We got some visibility yesterday from Apple. We've been waiting for WWDC and their big artificial intelligence unveil. Stock closed down 2%. I want to get your take on what you heard and what you saw and what you think about the stock.
Well, Apple is one of our granny shots. It's a stock that we think investors need to really hold for the long term. The company has always been at the center of everything that's happening around a consumer and new technologies. So to me, there might have been some head scratching because these features may not be part of someone's life just yet. But as you know, Apple gets a lot of these things right.
All right. So by the way, for the audience, your granny shot, it's kind of like almost a very easy shot. You think it's almost a no-brainer when it comes to that stock, right?
That's right. I think investors should look at it as a core portfolio holding. The granny shots is basically a thematic portfolio that buys the strongest stocks in a specific theme. So when you think of AI and millennials, Apple and Nvidia and Tesla, I mean, they're really at the center of that.
All right. But your sector picks when it comes to the AI trade are Nvidia, Cadence, ARM, AMD. Why isn't Apple in there if you believe that it's a core holding and obviously they're pushing into the AI space?
Well, mainly because Apple is much more than just an AI company. So I don't think it's intentional that we left out Apple when we talk about AI trades. But when our clients are looking for direct beta exposure, to them, the complex is Nvidia, and then stocks with high correlations to Nvidia, which are the ones that we actually listed.
All right. So, Tom, know what you're intentional about? Small caps. You've been one of the biggest bulls when it comes to small caps, specifically the IWM ETF. I'm just looking at the small caps since the last Fed decision. They're up 3%. The rest of the market's up about 6.5%. They've been lagging all year long. Is there still a case for small caps to rally as much as 50% this year in your mind?
Oh, yeah, definitely. I mean, one thing investors have to keep in mind is small caps get hampered when investors worry about lack of visibility. When the Fed begins to cut, and we actually have shown this to our clients, and the number of expected cuts begins to creep up, that has been correlated with the IWM outperforming the broader market. So the reality is the stock market is saying, look, I don't want to touch small caps until the Fed starts cutting. But in the meantime, small caps have better earnings growth, close to 19% in the Russell 2000 versus around 9% for the S&P. And the median PE multiple is actually around 10 times in the Russell 2000 compared to 16 times for the S&P. So better growth, lower multiples. I think it's a great risk reward for investors right now.
But aren't they also more rate sensitive and also more sensitive to the higher cost of capital and the higher for longer environment? I mean, you keep saying that investors don't want to touch them until the Fed starts cutting. We don't have any clarity. We might get some answers tomorrow, but it's unlikely. The Fed's been very clear. They're data dependent.
Sure, but I think what you've just described, which is higher cost of money, or a high bar for borrowing money, I mean, that's the existing conditions. So when the Fed starts cutting, that starts to ease. What would investors benefit from is having exposure to things that are levered to an easing of financial conditions. That would actually argue for small caps. So it's a bit of a waiting game, but boy, I mean, I don't know anyone who's made money trying to trade this week to week. Any great ideas, all the great ideas take time to work.
I mean, wow. Fair enough there. Is there any part of the small caps that you think are better than others? I mean, all small caps aren't created equal.
Well, one thing I think investors have to keep in mind is that they might think a small cap is like a weak company, but actually small caps, especially in the Russell 2000, tend to be very strong companies that dominate a smaller market. So that's why, they're not $1 trillion company, but they may be number one. Well, there's a couple reasons, Scott. The first is that I think markets are much more focused on inflation reports and CPIs next week and the June FOMC meeting on Wednesday. And the second, which of course we think is going to just show a continued improvement in inflation. But the second is that stocks really historically have done well in the week following the release of the employment report, rising roughly 70% of the time. And it implies roughly 70 to 80 points in the S&P. Of course, it would be better if it was a soft jobs report, and it wasn't.
Well, it's funny you say that. It would be better if it was a soft jobs report, because I think the market spent a good amount of today deciding, what it was. Was it good news is good news is bad news? I mean, if the market doesn't necessarily need rate cuts, why is a softer report better? Why can't we just be happy with good news? Labor market's strong, economy's hanging in, don't need rate cuts, and still may get them later this year.
I mean, I generally agree with you, Scott, but as you know, there's a faction of both market participants and the FOMC that view some of this data as too hot for them to be comfortable with. And I think, the more positive data points you get, the more you might actually start to see markets price in a hike. And so I think you're right. There is a Goldilocks window, but it's safer to say bad news is good news, because those actually clearly take away inflationary pressures.
I'm wondering if you think in any way that, thinking that June is going to be the point of the year in which we start to get this money off the sidelines and into the market, and how Goldman Sachs framed it the other day, talking about a, quote, wall of money coming in, but not really until July, that you could have some selling between now and then, but that the beginning of the third quarter, and thus the second half of the year, is the area to really plan for a wall of money coming into this market and then pushing stocks that next leg higher.
And Scott, that dynamic is certainly at play for a couple of reasons. One, April was a down month, and I think a lot of institutional investors actually sat out May thinking April was the start of a bigger correction, so June is when money starts coming back in. But I think more importantly, since the end of 2022, I think a lot of institutions and a lot of high net worth individuals sort of sat out this market saying, hey, I'm happy earning 5%. By the middle of this year, if the S&P is up 15%, on top of missing 30% last year, I think a lot of folks are going to say, listen, I can't just sit on cash and earn 5% anymore when I'm missing out potentially on a 25% year for the S&P.
Tom, what'd you make of the fact a couple times this week we had rates go down and stocks go down? Not exactly the dynamic that many had been expecting, right? Because that's not the way that stocks and rates have been reacting, right? They've been pretty well correlated. Rates down, stocks up. Well, there were a couple of occasions this week where that didn't work. Why?
It's kind of hard to tell, especially day to day, but if I had to guess, we don't want to be in a situation where the economy is slowing so much that we've actually hit stall speed, so rates would go down. That type of economic dynamic would scare stocks. So it's almost like bad news is too much bad news. In fact, maybe that's why today's jobs report kind of fits right in the middle, because it's actually good enough to tell us the economy is still strong, as you said, but it's not enough to actually add to inflationary pressures.
Tom, what if this market is just screaming out it's Nvidia's world and we're just living in it, right? I mean, if Nvidia's up, markets are good. Nvidia's not doing much, S&P can't do that much. Nasdaq's negative today. It's a one-stock story.
I mean, Nvidia is really a generational story for now, because how many $3 trillion companies actually have doubled, so clearly Nvidia is important, but it's important because it's really one of the most important ways to get exposure to AI. And I think the AI story is, early innings, as many people talk about. It's transformational in terms of productivity, and there's a lot of use cases developing. So as much as it might feel like a one stock market, as you know, there's a lot of stocks up more than 20% year to date. And I actually think breadth is likely to increase. So for investors, there's a lot of opportunities in the second half.